Welcome to Seven Bulls. We break down finance so that anyone can understand. Roll the intro.
Hello, fellow investors. Welcome to Seven Bulls, a WeGrow affiliate. Today, we're putting the Magnificent Seven, those titans of the tech world dominating the S&P 500 under the microscope. We're going to make a bold claim. Google, the undisputed king of search and online advertising, might actually be the most undervalued stock among these giants. Before we move on, if you find any value in the video, make sure to give it a like and share. It helps us get into the algorithm, in turn helping us grow the channel. Thank you. Now let's get back to it. First, let's set the stage. The Magnificent Seven, as you know, consists of Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. These companies have been leading the market charge, but their stock prices don't always tell the whole story. To determine which is cheapest, or perhaps more accurately, most undervalued, we'll focus on three crucial valuation ratios: price to earnings, PE, price to sales, PS, and price to book, PB. These ratios help us understand how much investors are paying for each dollar of earnings, sales, or assets, providing valuable insights into a company's relative worth. Let's start with the price to earnings ratio, a classic measure of how much investors are willing to pay for every dollar of a company's earnings. A lower PE often suggests a company is undervalued relative to its profitability. Alphabet's PE stands at a reasonable 23. This means that for every $23 you invest in Alphabet, you're essentially buying $1 of their earnings. Now let's see how that compares to the rest of the Magnificent Seven. Amazon is at 48, meaning you're paying almost double for the same amount of earnings. Apple comes in at a pricey 39.9, Microsoft at 36.6, Nvidia at a staggering 56, and Tesla way up at 106. Even Meta, with its recent challenges, has a PE of 28. Clearly, Alphabet takes the lead in terms of PE, indicating that investors are getting more earnings bang for their buck compared to the other giants. Next, we'll examine the price-to-sales ratio. This metric shows how much investors are paying for every dollar of a company's revenue. Again, lower is generally better, as it suggests you're paying less for the company's sales generation capacity. Alphabet's price-to-sales is 6.3. In comparison, all the other companies outside of Amazon price-to-sales are extremely high. While Amazon edges out Alphabet here, it's crucial to remember that Amazon operates on thinner margins, prioritizing high revenue volume over profit per sale. Alphabet, on the other hand, has a proven ability to translate a significant portion of its revenue into profits, making its PS ratio even more attractive. Finally, let's delve into the price-to-book ratio. This compares a company's market value to its book value, which is essentially the value of its assets minus its liabilities. A lower PB can suggest undervaluation, as it indicates you're paying less for the company's underlying assets. Alphabet's price-to-book ratio is a modest 7. Once again, Alphabet demonstrates a significantly lower price-to-book compared to most of its Magnificent Seven peers, suggesting that its assets are more reasonably priced and potentially undervalued by the market. But these ratios are just the tip of the iceberg. We also need to consider Google's unique strengths and competitive advantages. Alphabet has a long history of strong financial performance with consistent revenue and earnings growth. They dominate the search and advertising markets, generating substantial cash flow that fuels their expansion into new and innovative areas. Moreover, they're strategically diversifying into high-growth sectors like cloud computing with Google Cloud, a strong contender in the cloud infrastructure market. They're pushing the boundaries of artificial intelligence with Google AI, developing cutting-edge technologies with applications across various industries. And let's not forget Waymo, their self-driving car project, which has the potential to revolutionize transportation as we know it. This forward-thinking approach, combined with their core strengths, adds to their long-term value and growth potential. Of course, it's important to remember that cheap doesn't automatically equal buy. Every investment carries risks, and thorough research aligned with your individual financial goals is essential. So, what are your thoughts? Is Google the undervalued titan in the Magnificent Seven? Let me know in the comments below. And if you found this video helpful, please like this video and subscribe to the channel for more in-depth stock discussions. Keep up with your financial education. You're the only one in charge of your future. Be safe.
We grew.